What is value chain analysis and how to do it? A value chain concept was first formulated by Michael Porter in Competitive Advantage in 1985. In simple terms, value chain analysis is a systematic way of examining all of the activities performed by a business to determine the sources of competitive advantage and how these translate into profit. A value chain analysis is a process of analyzing and formalizing the actual value chain of the company. It is about understanding the economic reality of a business, how it works and creates value. It enables you to identify the real drivers of profitability within a group. This is a traditional view of VCAs that is usually used in the business context. It covers primary activities, support functions, and explains how various elements of the business work together to generate profits. However, value chain analysis is also important for tax. One of the most significant international tax reforms, the Base Erosion and Profit Shifting Project, highlighted the fundamental international tax principle. Transfer pricing outcomes should be aligned with value creation. In other words, the way M&E price their intercompany transactions should lead to the fair distribution of profit among countries and entities that create value. Therefore, VCA became a valuable instrument for assessing value creation within multinational groups. But how do you actually do the value chain analysis? It is possible to do it manually, using spreadsheets and industry reports, explaining supply chains with diagrams. However, that's often ineffective and not what is needed for international tax. That's why there is an application and a digital workflow for doing it. The first step is to define the legal entities and jurisdictions in scope. Then, map contributions, including functions, assets, and risks, to the legal entities. Add actual allocations, in other words, how your group EBIT is distributed between group entities based on historical data. This will be later used as a comparison to the modeled allocations. The next crucial step is assigning value allocations. Here, you must first define the relative importance of different responsibility roles. For example, you can use average wage levels of different job titles or differences between job grades. This will produce the role-based allocation shown on the outcome table on the right. Remember to comment on your selections to ensure you have records of the rationale behind different numbers. If you want to predetermine the absolute value share obtained by different contributions, you should include contribution-based weights here. For example, you can use cost-center data or contribution analysis to find the weights. This will give you the second allocation in the output table. Again, remember to comment on your selections. Then indicate if value driver weights. This is the most complete allocation method, utilizing the previously provided role and contribution weighting and adding value drivers, thus completing the OECD framework. You should first distribute 100% of allocable value to different value drivers. Next, you should determine how big of a share of each value driver is materialized through various contributions. For example, if your value driver is sales-related, then naturally sales and marketing contribution would constitute a higher percentage than, for example, finance. In this process, you could use your group's performance management indicators or Likert-type questionnaires. This phase will produce the third allocation, value driver-based, in the output table. After completing the data, you can get valuable insights into the value chain. For example, you can check how the results of allocation methodologies compare to reality. In this illustration, we see how contribution-based allocation compares to the actual distribution, and in the next one, value driver allocation versus actual results. Our favorite is Group Sunburst, which shows how 100% of group profits are being generated by various entities, functions, and value drivers. Another benefit of using a digital transfer pricing solution for value chain analysis is that you can use the same data model across various applications. For example, functional analysis from TP documentation can be used for VCA, and the results can be automatically cross-checked with a country-by-country report. As a result, you can build an end-to-end system that enables full real-time control over your transfer pricing, where all applications are integrated and synchronized.